You know, we all get into dividend investing for that sweet, sweet passive income, right? That idea of a steady stream of cash just showing up in your account. But there's this silent killer lurking in your portfolio, and its name is taxes. Every single year, it's quietly skimming off the top, slowing you down. So today, we are going to pull back the curtain on this hidden cost. And we're going to break down two powerful and very different strategies to help you keep way more of your hard-earned money.
Okay, so here's our game plan. First up, we're going to tackle the big problem, the dividend investor's dilemma. Then we'll dive into two completely different solutions, the long-term Buffett blueprint and the more active wealth wheel. We'll also get into the nitty-gritty of the ex-dividend date. You have to know this before we wrap it all up and help you figure out which strategy makes sense for you.
All right, Section 1, the Dividend Investor's Dilemma. We're calling this the silent leak because that's exactly what it is. It's this constant battle every investor faces. On one hand, you've got the amazing promise of consistent dividend income. But on the other, you have the cold, hard reality that taxes are always there, taking a bite out of your returns.
I mean, this quote just nails it, doesn't it? This is the dream. You just buy the thing and then it just pays you. It's the picture-perfect image of passive income. Your money is out there doing the heavy lifting for you quarter after quarter. It's simple, it feels good, and it's exactly why so many of us are drawn to dividend stocks in the first place.
But, and there's always a but, right? Behind that beautiful dream, there's this hidden cost. It's this persistent drag that most people just don't account for. Think of your portfolio like a ship on a long voyage. This isn't a giant hole. It's a slow, steady leak. And over decades, even the smallest leak can leave you miles behind your destination. And that leak, of course, is taxes. So let's give this problem a name: tax leakage. It's what happens every single time you get a dividend or sell a stock for a profit. A piece of that money vanishes before you can put it back to work. This creates what one of our sources calls the acidity of taxes. It literally eats away at your ability to compound your wealth over time.
And just look at this comparison. It really tells the story. On the left, you have this perfect world of gross returns. 100% of everything you earn goes right back to work for you. But in the real world, we live over here on the right, the world of net returns. A slice gets taken for taxes before you can reinvest. That means your compounding engine is running on less fuel. It might not seem like a big deal in 1 year, but over 20 or 30 years, wow, the difference is absolutely massive.
So the big question is, how do we plug this leak? Well, our first strategy is what we're calling the Buffett blueprint. This is all about playing the long game. It's a strategic approach built on patience, quality, and harnessing the incredible power of tax deferral. And this quote right here is the whole secret sauce. For Warren Buffett, finding a company with long-term prospects isn't just about good business. It's a core part of his tax strategy. By simply not selling, he avoids triggering that capital gains tax that just crushes more active traders. He lets his money grow and grow on a pre-tax basis for as long as humanly possible.
And the impact, whoa, it is staggering. Let's look at this 20-year example. Both investors start with 50 grand. The frequent trader on the left is constantly buying and selling, creating taxable events and shrinking their pile of cash every year. But the buy and hold investor, they just sit on their hands. Sure, they pay tax on the dividends they receive, but that huge capital gains tax bill, it's pushed way off into the future. And the result? Their $50,000 balloons to over 336 grand. That's the magic of letting your money work for you, uninterrupted.
Okay, so how does this actually work? How does the value grow so efficiently? It comes down to something called book value. Think of it this way. A company makes a profit. It has two choices. It can give that profit to you as a dividend, which, boom, creates a tax bill for you. Or it can take that profit and reinvest it back into the company to grow, build new factories, create new products. When it does that, the company's net worth, its book value, goes up. And for you, the shareholder, that growth is completely tax deferred. You don't pay a dime on it until the day you sell. So here's the blueprint step by step. 1, you buy quality companies. 2, and this is the key, you look for companies that reinvest most of their earnings. A really good rule of thumb is to find one that pays out about a third as dividends and plows the other 2/3 back into the business. This gives you the best of both worlds. You get a little income now, while most of your investment grows tax-free. And then step 4 is the easiest and hardest part. You just hold on for dear life, pushing that big capital gains tax bill as far down the road as possible. Now, the Buffett approach is brilliant, but it takes decades of patience. What if your main goal isn't just long-term growth, but generating consistent cash flow right now? Well, let's shift gears completely and look at a much more active, tactical approach to generating income. This strategy is called the wealth wheel, and it's a totally different mindset. It's not about deferring taxes. It's about actively generating multiple streams of income from just one stock. Now, the number one rule here is that you have to be okay with owning the underlying stock for the long haul, because there's a good chance you'll end up doing just that.
So let's break down how this wheel actually turns. Step 1, you literally get paid to agree to buy a stock you already want. You do this by selling something called a put option. Someone pays you cash, a premium, today for the right to sell you that stock at a set price later. If you do end up buying the stock, you move to step 2. Now you own it, so you start collecting the regular dividend payments. But you don't stop there. Now you move to step 3. You get paid to agree to sell it. You sell a call option, collect another premium, and if your shares get sold, great, you can start the whole cycle over again. Every single step generates cash, but, and this is important, every step also creates a taxable event.
And check out this real-world example with Dow Inc. The stock pays a nice 70-cent dividend. But by running the wealth wheel, this person generated an extra $1.84 per share from options premiums. That's more than twice the dividend. All told, that's $2.54 in income, which also lowers your break-even price on the stock. It's an incredible income booster, but you have to remember, every single premium you collect is taxable income you'll have to deal with. Okay, so whether you're a long-term Buffett disciple or an active wealth wheel trader, there is one single date that you absolutely positively have to understand. It's the linchpin. It decides who gets paid the dividends, and it creates a huge risk for anyone trading options.
So let's get crystal clear on this. The ex-dividend date, or just X date. The X literally means without. So this is the first day the stock trades without the right to get the next dividend payment. The rule is super simple. To get the dividend, you must own the stock the day before the ex-dividend date. If you buy it on or after the X date, you're too late.
And this timeline puts it all in order. First, a company declares a dividend. Then comes the big one, the ex-dividend date. After that is the record date. That's more for the company's bookkeeping. And finally, there's the payment date, when the money actually shows up. But for you, as an investor making decisions, the ex-dividend date is really the only one you need to circle on your calendar. So why all the fuss about this one date? Well, for a regular dividend investor, it's simple. Own the stock before the X date, get paid. But for a wealth wheel trader, this is where things get dangerous. See, the person who bought your covered call has a massive incentive to exercise their option right before the X date. Why? So they can grab the stock and get the dividend instead of you. If that happens, you are forced to sell your shares, whether you wanted to or not, which immediately triggers a capital gain and a tax bill you probably weren't planning for. It's a huge risk you have to manage. All right, we've laid out two very different playbooks. One is a strategic, long-term game of tax deferral. The other is a tactical, short-term game of cash flow. They both work, but they are worlds apart. So the real question is, which one of these blueprints is right for you? This table really boils it all down, doesn't it? The Buffett blueprint is for the patient accumulator. Your mindset is, I am a part owner of this business. On the other hand, the wealth wheel is for the active income generator. Your mindset is more like, I am running a business that generates cash flow from this stock. There's no single right answer here. It's all about aligning your strategy with your personal goals, how much time you have, and your personality. So I'll leave you with this final thought. Now that you understand tax leakage and you've seen two powerful ways to fight back, take a really hard look at your own portfolio. Is it actually built for tax-efficient growth, or is it silently leaking value year after year? Answering that question is the very first step to plugging those leaks for good and making sure that more of your money stays where it belongs, with you.